Hi, everyone. I'm Rick Bensignor. Today is Tuesday, February 1st. Welcome to this week's newest In the Know Trader Show. On tap this week in trader education, we're going to talk about playing a long-awaited breakout. We'll look specifically at a name, what it means, and how to identify it and play the breakout. In our market overview, we'll take a look at the Dow, the Russell 2000, the US 10-year, and the XLE, which has been on fire. And we're going to stay in the energy sector for our sector analysis and go through the top dozen or so names in the XLE to see, despite how much it's moved up, how much more these names might have before they run into resistance and pullbacks, and or where to buy on pullbacks. Certainly we saw some type pullback over last month, and we'll see what those things look like. To sign up for my weekly ETF Tactical Trader Report, go to intheknowtrader.com, and to get the monthly 7-11 report, which just came out last night. That comes out on the last night of each month, with the goal of beating the S&P. And what we do is allocate anywhere from 5 to 7 of the 11 macro spider ETFs to be in at any one time, with the goal of staying away from the underperforming sectors. And just think about it, if you can avoid the underperforming parts of the market, you will outperform over time. Now, easier said than done, considering historically 6 out of 7 people who do it can't do it. But we at least find ourselves in the 1 out of 7 who can, as of now. Last month, we outperformed by 69 basis points. And our fiscal year, which starts August 1st each year, we are up, I think it's 1.4% outperforming the S&P. For this fiscal year. And since we started in August 1st of 2020, we are up outperforming, I think it is by 4.4% in the 18 months. And for those of you who are in the money management business, especially professionally, that is huge. If you can outperform the S&P by 4.4% in a year and a half, you are doing great. So that's what that report is about. Again, it comes out once a month. We allocate across anywhere from 5 to 7 sectors to be in, and we are doing well. So to find out more, go to intheknowtrader.com, hit the sign up tab, and you'll see more about it, as well as pricing for those 2 pieces that we do. All right, let's take a look at just what the markets are doing year to date. So from the close on December 31st through last night's close, you basically have one standout to the upside, that is energy. It outperformed by almost 24%. That's 2,400 basis points last month. Being up almost 19% versus the S&P's loss of about 5.25%. The only other macro sector up in January was financials. They were up 0.03%, so virtually nothing. But that was a heck of a lot better than the other ones that were down. Of course, consumer discretionary was the really hard hit one, down 9.5% for the month. Tech was down 6.85 or so. And real estate down 8.63. So those were kind of the standouts on the downside. Although now when I look at materials and healthcare, we're virtually the same as tech. And staples outperformed, makes sense, but still down. You lost money in staples, you just didn't lose as much as the S&P. But that is what the game of relative performance is about, and that is what we do in the 7-11 report. Okay, let's talk about a little bit playing a long-awaited breakout. Well, normally breakouts that are true breakouts, as compared to, let's say, what the Russell 2000 was in the fall where it broke out to the upside after being sideways for the entire year. In fact, let's look at it. It's easier than just talking. So here, let's go to, we're going to look at this anyway, so it's a little out of order, but just for example purposes, the Russell 2000 was trading completely sideways last year, back and forth in a range, breaks out to the upside. 2 weeks later, comes back here. You still could be a buyer, but certainly somewhere in here, you knew that was not going to be a breakout that was going to hold. And buying breakouts or selling breakdowns that look real are generally the right thing to do. You've got to have stops in case like this, you get an example of something that ends up being a false breakout. And this completely, this move, as markets often do, will get a fake move in one direction before they get a much bigger move in the opposite direction. And that's exactly what we saw. But by and large, you want to buy breakouts that look to be real breakouts and sell breakdowns that are real breakdowns, unless you're willing to, just sit with stuff that is going against you and hope it works out, over the long term. If you did that, let's say in cannabis stocks, and you were long a name like Tilray, it's now less than 1/10 of the price it was. In fact, probably closer to 1/20 of the price that it was on its all-time high. So, hoping is not usually a good strategy. But let's talk about breakouts and what I'm seeing now in one particular place that I think it's something we've jumped on already before the breakout occurred. But here is a total trading history of the XLE ETF, right? So the S&P 500 energy ETF versus the SPDR, the S&P 500 itself. So this is a relative performance chart over time. And you can see that from 2004 through mid-2008, you had a massive 4.5-year outperformer, and that it has been basically underperforming since 2008, which is now 14 years. So one thing is that, this has been a long-term dwindling picture, and it's just been a horrible place to have been invested in for the last dozen years. But we could take this a step further and say that its all-time low up until 2020, you're still underneath water. So if you go back to, let's just say, roughly 2000, give or take, this is the only part of the stock market in general broad sector terms that you've actually lost money. Can you imagine where the S&P was in 2000, where it is now, and how much it's up? And yet, if you were long energy this entire time, you're actually down money. Nowhere else in the market would you have lost money. In fact, nowhere else in the market would you have only made a little bit of money. You would have made a lot of money to be in the stock market anywhere but this sector. So it has been a terrible underperformer, certainly since 2008, a net underperformer since you started trading XLEs in I guess it was just about very end of 1998, early 1999, and you're almost at what had been that all-time low. Whether or not this all-time low actually matched up to where a market was at the time is we'd have to do more work. But as far as when these SPDRs came about trading, that was the all-time low until the 2020 early of the year sell-off because of COVID, and now starting to recover. Okay. Let's also take a look at, if I took a trend line from the all-time high, no, that's not the one I was doing. I'm trying to think, what was I looking at before? Well, it'll come to me as we're talking about it. Now, let's take a look. Let's blow this up. And what do we see here? Well, any technician knows that this pattern here is an inverted head and shoulders. So we can draw either certainly a neckline like that, which we've clearly broken out from. There's even a second shorter term inverted head and shoulders here. So you've got two inverted head and shoulders in the worst performing sector of the market over time, which makes me feel, and I've been bullish this since August. We bought this low right in here when it went full overweight the energy sector. I was anticipating that this was going to turn around at the time, if I remember correctly, if I put up a DeMark sequential model. Yeah, there was a setup 9 down here too. So I was playing for that 9 to be the bottom of this pullback and that we would turn and go higher. So we clearly have an upside breakout. And I have no reservation playing this to at least get back towards or to what was that previous all-time low. Again, I'm not sure I can give much credit to that all-time low having been a significant level. Again, it kind of just happened at the time that ETFs, that the sector ETFs started trading. But my view is that this is significant and should lead to further outperformance. And certainly, you know that if this pulls back, you have an area of where these necklines broke out from that you'd want to be, or at least I think of buying on a pullback. Besides this level being here, I know what it was. It comes to me as I look at this. If we take a look at the height of the head, we've got almost, let's call it 3 boxes worth of, so 1, 2, let's call it about 2 3/4 boxes of height. So if we add that to where we break out from, 1, 2, 2 3/4, that puts us up somewhere, and I'm just guessing, but somewhere around here. And that to me is probably a realistic target over time. And it may not be all that much time because energy continues to just, push higher. And as a technician who always likes to look at the long-term perspective of what we're doing in the context of shorter term, I think this breakout is very significant. The lows made back here in 2020 probably started a secular bull move that will last. Cyclical we typically think of as a year or so, secular as multi-year. I believe that this is a multi-year catch-up in the energy space, not to be confused with catch-up, but catch-up of energy relative to other sector performance, such that this should be now what I expect will be years of outperformance, or at least certainly holding its own versus the rest of the market. In other words, it is certainly time to be invested in the energy space after having been a horrific place to have been invested in since 2008, and longer term, versus if you go back to 1999, where you're down money over that 20+ year period. I think, yes, we'll look at technicals, we'll look at certain levels that this could potentially stall, but my guess is energy has seen the worst that it will see in a secular point of view, and you really want to have exposure here more so than other sectors. Now, it's only 3% of the S&P. In fact, I think it's exactly 2.7% of the S&P. So I have no problem being at least double weight that and putting at least 6% of a portfolio into energy, because I think this is a sector that will finally really play some catch up and be a place that on pullbacks, my guess is we will not go back to these lows from 2020 again. And that's somewhere, if we get a pullback somewhere into these neckline areas, are as good as you're going to get on a pullback, and that's most likely your buying opportunities in the future. That's today's little lesson on playing a breakout, and this one in particular. Let's take a look at some charts of what's going on around the market. So let's take a look at, let's see, where do I have the Dow Jones? It's not here. So let's just turn it into, actually, I'm going to look at it in terms of diamonds, which are the ETF that tracks, because this you can actually trade as compared to the Dow itself, which you really can't trade. So let's put up, similar to other markets, last week's lows held against prior lows from 2021. I've also got, eyeball this. I see there's a TDST line in here too. So, we had at least some type of defined zone. And the question is, how far can this go to the upside? Is there enough reason to think that we're going to just turn around and make new all-time highs? So if we take a look at a retracement, we're somewhere near, I would guess, at 50%. Let's just see. Okay, so we're a little through the 50% retracement. My guess is if you look at the 62% and the unfilled gap here, so that's about as good as I think it's going to go now. I don't think there's enough reason to simply assume the way the mega, oh, it's hard to see that gap. Watch, I'll blow this up. There's the gap. It's hard for me to think that this is going to just turn around like it's done in the past and zoom to new highs. Part of that reason is credit spreads have widened out. And for those of you who don't know what a credit spread is, it's the difference in yield. The credit spread I look at are versus investment grade bonds, or an index that tracks investment grade bonds of BBB or better, versus the yield that you get on US Treasuries of comparable maturities. And those spreads are widening out, and widening out of credit spreads is not a typical thing you would see that would suggest that equities would just simply keep going higher. So my guess is this, whether it's the Dow, the S&P, the Qs, do not make new highs on this rebound move, and that I'm looking to potentially lighten up just some medium to longer term stuff that I have in my equity portfolio. It's a good chance to clean out some of the crappier stuff you have in there on the strength, to just get rid of names that have either cost you money or you've made money on, but they've underperformed. Recently, it's certainly not surprising that if you've got some tech names, you could be down 30, 40, 50% or more since last year, because the average NASDAQ stock has gotten killed since about February or March of last year. We've looked at that in the past when you look at NASDAQ breadth, and it's been atrocious. So most people are getting hit hard on many of their NASDAQ names. Use some of the strength to lighten up and get rid of the bad stuff. And you can use those if you actually lost money. You could offset them against gainers, so that the gainers you don't have to pay tax on if you can offset against losses. So you can talk to your accountants about that. I don't want to get into a tax lesson, but selling losers is not always a bad thing. You can take advantage of the loss to offset gains. So that's the Dow, the Russell we actually looked at. So let's take a look at the US 10-year. And here's the 10-year. And what's most important here is two things. One, there's an inverted head and shoulders, which broke out of its neckline. The neckline is this green line, right? So we took the high of the shoulder to the high of the right shoulder. In fact, both pieces of the right shoulder happen to touch on the line, and it's now moving higher. So to a classically trained technician, this is on a breakout. To me, you've got to get above 1.86% on Friday closes, and the more the better. Because back in 2021, when we were trading at 1%, I told my clients that you had to get above 1.86% to truly have a more long-term bottom in place. So yes, it does appear like it's moving higher. Notice that we're stalling. In fact, what's This year's high is 1.87%, 1 basis points away from a year ago where I said we need to hurdle. And and if we get above that, then I'll have more confidence that we next get to 2.25% to 2.5%, which are next upside targets I have from different models. That's that. Now let's look at the XLE itself. We've already looked at it versus the S&P. Here is the XLE on a weekly chart. We're above the cloud. The lagging line's above the cloud. That's bullish. So let's take that away. Take a look at some wave stuff now off of the 2020 lows. Wave 1, 2, 3, 4. We're in the 5th wave up. Equal legs up. So if wave 5 was equal to wave 1's height on top of the bottom of wave 4, it would have measured to here. We actually stopped there and pulled back, but now we're through. So now I'm going to look at what's 1.618 times wave 1 to add to wave 4, and that targets here at 76.60, which is also similar to other targets, a TD/ST line and these other propulsion targets up here north of 75. So that's where I'm going to possibly take some off and look to, play for a pullback in this. But obviously, in general, I like this. And longer term, you can see this is much choppier than what XLE versus the S&P looked like. But, here, let me take some of these lines off now. But you see that, you have this whole zone up to also upper 70s that has been prior resistance in the past. So that certainly is a potential stalling point, and that is in between the 75 and 78 level where I have other targets to this. So that's probably a place to lighten up and look for a pullback from. Let's look at the individual names now. So we're going to we'll start with, actually, I might have put this up. Yeah. Here's Exxon. Long-term chart. Here is the all-time high. So trend lines from the all-time high have broken. That's good. The last pullback we had held the uptrend line. So all is good here. Now, again, you're going to run into some problems, and it's a matter of picking any one of these, potential highs is a place that this could run into problems with. So anywhere in those lines. And it's a matter, so I'm going to look at what the counts are to see if, I get another set of 9 or a 13 signal that coincides with these. Otherwise, I'm a buyer on pullbacks. Take a look at this level here, which we've broken out from 2. So all things good here by pullbacks. Chevron, better look at this relative to Exxon. I'm going to go back to Exxon. Look where Exxon is relative to prior highs from years back, and look at Chevron on all-time highs. Big difference. So this is stronger. Now it does have a weekly 9 count here. We know 9 counts can stall a market. They did on the all-time high. It did in here. It did in here. This one went sideways for a month and a half or so. You are getting closer towards some exhaustion here, but I may wait for this to get a 13 before I'm finished. But nothing wrong with taking some profits if you like to do that. Here's a name that EOG, the 3rd biggest name in the XLE, same thing, running, still has weeks to go. Looks like we broke down from here and there. Sure enough, is just about where we are now, right? Oops, let me just draw a straight horizontal line. But you get the point that after making the all-time high, we broke down from this level, and there we are right now. So potentially some resistance from it. Conoco Philips, COP, all-time highs on a weekly 13 right now. With a 6 count, you could either wait for another few weeks or wait for this to do a negative price flip by closing beneath the close from 4 bars prior to take profits, but that's certainly on alert for potential decline. Schlumberger, much worse than these other names. This is in the oil service space, clearly much weaker over time. Same type thing here. We had a 13 a couple of weeks ago, might be getting exhaustive, but we're still in the midst of a new count. So look for that to potentially still go higher, but on a watch for a pullback. PXD, So Pioneer virtually getting to this potential resistance level of 223. We're trading at 221. Same type thing over the next few weeks. Could easily let this run a little more. Could easily be a reason to take some profits in it. And we have time for, I think, one or two more. Here is Marathon Petroleum, best level in years. You have to go back to 2018, getting closer to all-time highs. It has broken out above. I would probably use that level as what, the resistance was. 3 times we got there. We're through it, so that's good. Short-term trend line like this is probably a place to look to buy and pull back. That's going to be it for this week. Hope you enjoyed the show. I'm Rick Bensignor. This has been In the Know Trader.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.